Transaction cost economics, TCE, looks at the hidden costs of doing business with other firms. Imagine a coffee shop that can either brew its own beans, make or buy roasted beans from a supplier buy. The price of buying includes not only the bean cost but also contract negotiation, monitoring the supplier's quality, and the risk of price swings. Search and information costs, time and money spent finding a reliable bean supplier. Bargaining and decision costs, drafting contracts, negotiating terms, and obtaining approvals. Monitoring and enforcement costs, checking that the supplier delivers on time at the right quality and dealing with any breaches. If the sum of these transaction costs exceeds the internal production cost, including equipment, labor, and overhead, the firm should make. The model is often expressed as make if C internal is less than C external plus TC, where TC is total transaction cost. In practice, firms use transaction cost economics to decide whether the market is efficient enough to outsource, or whether internal control provides a cheaper, more reliable outcome. Explanation: a cost-benefit and break-even analysis quantifies the financial trade-off of integrating a function. Using the coffee shop example, suppose the shop can invest $I to buy a roaster, incur a fixed annual overhead F, and a variable cost per pound of beans V sub M. If it buys beans, the variable cost per pound is V sub B, and there is no fixed cost. The break-even point Q star pounds of beans per year is found when total costs are equal. I plus F plus V sub M Q star equals V sub B Q star. Solving for Q star equals I plus F divided by V sub B minus V sub M. If the shop expects to roast more than Q star pounds annually, making becomes cheaper. The analysis can be extended to include depreciation D, tax shields, and economies of scale. A full benefit cost ratio, BCR, can be calculated as BCR equals the sum from T equals 1 to N of benefit sub T divided by 1 plus R to the T, divided by the sum from T equals 1 to N of cost sub T divided by 1 plus R, to the T where R is the discount rate and N the planning horizon. A BCR greater than 1 supports integration. Real-world analogies include Apple designing its own chips M1 versus buying from Intel. The break-even analysis would include R&D, fab costs, and the per-chip savings. Core competency theory, popularized by Prahalad and Hamel, tells firms to focus on what they do best and outsource the rest. In the make versus buy context, the first step is a strategic fit matrix that plots activities on two axes: importance to competitive advantage and current firm capability. Activities that are high on both dimensions, for example Zara's rapid fashion design and logistics, should be kept in-house. Low importance, low capability activities, for example cleaning services, are prime candidates for outsourcing. A simple scoring method can be used. Score sub I equals W1 times importance sub I plus W2 times capability sub I, where W1 and W2 are weights reflecting strategic priority. The firm then ranks activities. Those above a threshold are make. For example, Toyota keeps engine manufacturing core, but outsources seat fabrics. The assessment also looks at learning spillovers. Does making an activity help develop complementary skills? If yes, keep. If no, consider buying. Opportunity cost captures the value of the next best alternative foregone. When a firm decides to integrate, it gives up the chance to invest capital elsewhere. Suppose a firm has C dollars of free cash flow. If it invests I in vertical integration, the opportunity cost is the return it could earn by investing the same money in a project with ROI R sub alt. The net benefit of integration is net benefit equals ROI int minus R sub alt, where ROI int equals incremental cash flows from integration divided by I. Discounted cash flow DCF analysis extends this by discounting future cash flows at the firm's weighted average cost of capital WACC. The formula for net present value NPV of integration is NPV equals the sum from T equals 0 to N of CF sub T divided by 1 plus WACC raised to the T power minus I. If NPV is greater than 0, the integration beats the best alternative. A practical analogy: A car manufacturer could build its own battery plant, which is integration, or invest the same cash in expanding its electric vehicle line, which is the alternative. The DCF comparison tells which use of capital creates more shareholder value. Risk and control are intangible but crucial factors. By integrating, a firm gains operational control. It can set quality standards, adjust capacity quickly, and protect proprietary technology. However, integration also introduces concentration. Risk a failure at the new plant can halt the entire supply chain. Outsourcing spreads risk across suppliers but reduces direct control. A useful tool is the Supply Chain Reliability Index (SCRI). SCRI equals average on-time delivery rate divided by number of critical suppliers. A high SCRI for a single in-house supplier suggests reliable control, whereas a low SCRI for many external suppliers may indicate vulnerability. Companies often run scenario analysis. For example, what if a natural disaster shuts down our in-house plant, and assign probability-weighted costs. Real-world case: Boeing's decision to outsource many 787 components led to supply chain disruptions, prompting a later push for more in-house production of critical parts. Explanation: Game theory helps predict how competitors will react to a firm's make or buy move. The classic model is a two-player simultaneous game where each firm chooses either make M or buy B. Payoffs depend on cost advantages and market share effects. Competitor M and competitor B columns. Firm M versus competitor M yields 6,6. Firm M versus competitor B yields 8,4. Firm B versus competitor M yields 4,8. Firm B versus competitor B yields 5,5. Numbers represent profit units. The Nash equilibrium occurs where neither firm can improve profit by unilaterally changing strategy. In this matrix, 6,6 is the equilibrium, both make, reflecting a mutual integration scenario often seen in vertically integrated industries. For example, oil majors owning upstream and downstream. More advanced analysis uses Stackelberg leadership. A firm moves first, for example decides to integrate, and the follower reacts, for example decides to outsource. The leader can capture a first-mover advantage by locking in scarce inputs or creating entry barriers. Real example: Amazon's decision to build its own logistics network forced many retailers to either partner with Amazon, buy, or invest heavily in their own delivery capabilities, make. Regulatory and antitrust rules can block or limit vertical integration. In the United States, the Clayton Act prohibits mergers that substantially lessen competition. The horizontal-vertical merger guidelines require agencies to assess whether integration would give the firm the power to foreclose rivals from essential inputs or markets. For instance, a dominant smartphone operating system maker buying a key component supplier could raise concerns that it will deny competitors access to that component. Legal constraints also include industry-specific regulations. For example, utility companies often need approval from public utility commissions before acquiring generation assets. Companies must conduct a horizontal-vertical competitive impact analysis, estimating the Herfindahl-Hirschman index change. Delta HH I equals the sum over I of S I post squared minus the sum over I of S I pre squared, where SI are market shares. An increase of more than 200 points in a concentrated market, less than 1,500 HH I typically triggers scrutiny. Real-world case: the United States Department of Justice blocked AT&T's attempt to acquire T-Mobile in 2011 because of vertical foreclosure concerns. Financial modeling brings together NPV, IRR, and sensitivity analysis to give a quantitative picture. The NPV formula shown earlier accounts for cash flow timing. The internal rate of return, IRR, is the discount rate R star that makes NPV equal to 0. 0 equals the sum from T equals 0 to N of cash flow at time T divided by 1 plus R star to the T minus I. If R star exceeds the company's hurdle rate, the project is attractive. Sensitivity analysis tests how results change with key variables. For example, cost of capital, demand growth, or supplier price volatility. A tornado chart visualizes which variable most impacts NPV. Example, a fashion retailer evaluating in-house garment manufacturing may build a model with variables such as labor cost increase plus or minus 10%, fabric price swing plus or minus 15%, and discount rate 8 to 12%. The model might show NPV ranging from negative $5 million to positive $12 million, indicating that labor cost is the biggest risk driver. Decision makers can then focus on mitigating that risk, for example by locking long-term labor contracts. Past MBA exam questions often test the ability to structure a make versus buy analysis and perform quick calculations. Example question: a consumer electronics firm can either manufacture a new battery in-house at a fixed cost of $40 million and a variable cost of $30 per unit, or purchase the battery from a supplier at $45 per unit. Expected annual demand is 2 million units. The firm's required rate of return is 10%. Should the firm make or buy? Show your calculations and discuss strategic considerations. Model answer brief. Compute break-even quantity. Q star equals I divided by V by minus V make equals 40 million divided by 45 minus 30 equals 2,666,667 units. Expected demand 2 million is less than Q star, therefore buying is cheaper on a pure cost basis. Net present value of making equals negative 40 million minus 30 times 2 million, which equals negative 100 million. Net present value of buying equals negative 45 times 2 million, which equals negative 90 million. Discount at 10% over 1 year gives the same ranking. Strategic discussion. Battery technology is a core competency for the firm's brand differentiation. Vertical integration could protect intellectual property and improve supply security, but high fixed cost and uncertain demand pose risk. Recommendation: buy for now, monitor market. Consider phased integration if demand grows above break-even. Such questions test both quantitative mastery, such as break-even and net present value, and qualitative judgment, such as core competency and risk.